What's up, everybody? Michael and Coco here to do some technical analysis on the financial markets. We're going to be looking at some individual indexes today in the stock market on different time frames. We're going to be talking about indicators and then also some commodities and currency today. I'm going to try to keep today's video very compact and to the point. Let's go ahead and get into it. All right, welcome back. If it is your first time here, welcome to the channel. I do these videos Monday through Friday. If you will go ahead, please hit that like button if you do like this content. It is much appreciated and it helps get it out to more people. So please and thank you. We're going to go ahead and start off on the weekly time frame for the S&P 500. First, really the only thing that I want to point out here is this inverted hammer candle that is forming. The week isn't over, right? So today is the 14th and it's Wednesday. And it really depends where this candle closes. If it stays something like this, that is a very bearish type candle from a move up. If you look just down here, you had the inverted hammer on a move down. And look what happened. Well, we saw the move up. So if we finish something like this, it could very well potentially send us downwards. Now, we're at the very top of this megaphone pattern or widening wedge. So we got to keep our eye, got to take note of it. Now, it really depends on where next week kind of follows through. You need confirmation in order to say, okay, this does look very bearish. Now, overall, looking at this, we're pretty disconnected from the 5 EMA, which is this blue line kind of next to this black trend line. So that is pretty overextended, and we're at the top of range. We were earlier this week, the top range of the Bollinger Band. Let's look at the daily time frame. All right, so here's the daily time frame for the S&P 500. Today, we closed this gap that from the previous few days ago when we gapped up. We've been talking about all the air pockets that have been left within this big ramp up. See, there's 1, 2, 3, 4, and there was 5, and we closed one of them today, which is a good sign saying, hey, the market is, realizing what we have beneath us. Now, the same thing happened here in the run-up in August, and you can see September filled all those gaps. Now, there is still a gap ahead of us too from this close and then open here, and that's when we saw that big pull down. So, it's anybody's game at this particular point in time still. So it could be bullish, it could be bearish. On the 2-hour time frame, I'm going to show you a more bullish type pattern, but it could very well turn on us too as well. Now, today's candle looks pretty bearish, but I want you to notice that we're back within the Bollinger Bands, and we tagged the 5 EMA and kind of bounced from that level. Now, that's also, right where the gap window got closed. So there's a little support there, a couple areas of confluence for support. We saw that little bounce. I personally wouldn't think about going long at this 5 EMA with everything that's going outside of the stock market, the political side of everything and all the news headlines that could potentially arise. So right here doesn't look too safe, but lower down here by the original neckline could be a potential better opportunity in my personal opinion. The neckline I'm talking about is this inverse head and shoulders pattern that we broke out of, and we moved really high, really fast. That's because the shorts had to cover, which means that they had to buy back shares, and that's also from momentum traders buying into that move to the upside. So we got gap, 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 and we just squeezed really high at a very fast pace comparatively to August. This kind of reminds me of, I don't have the chart ready, but I do remember in 99 to 2000, 2001, right there where the tech boom is, we saw this huge monster run up, then a really sharp declines like this, and then a run up, and then another fall down. So not saying that that's what's going to happen, and I'll show you here on the 2-hour time frame, a couple concerns that I have, more bullish type scenario that I have. So here is the 2-hour time frame. I posted this on my Twitter. If you don't follow me there, follow me on Twitter. I do, like I said, plan on making more structural content for Instagram as well. So if you're on Instagram and you're not getting that many charts, well, trust me, they will be coming here in the near future. I just need to, make sure that I structure them correctly. That makes sense on that platform. So we have this gap close. That's why it's in white right now. And really all day, well, at least for the last 4 hours of trading, we just tagged in the channel, top to bottom, and we finish right there in the darn center. So to me, that means, hey, the market's uncertain where to go within this gap range that it filled. It could be one of these things that something takes place after hours in the futures market, which sends us either gap down lower or potentially we move up higher. The bull scenario here is, well, this could be very well consolidation. This could be a bull flag forming, and we might break out to the upside. That's possible. So mind the current pattern in the current context. We broke out of a bullish pattern, the inverse head and shoulders. Yes, we have a lot of gaps. Now we're consolidating. This could very well be called a bull flag. So don't just go, shorting the market right here. It might be the best idea ever. But hindsight's 2020, so we don't really know. So as I see it, we're not at a major area of support. We're not at a major area of resistance, although there are indicators that we'll get into that look very overextended. So right now, for me personally, I'm just not going long on, and if I do go long, the setup has to be really good. And on top of that, it has to be in a sector that has been performing. So that's just my personal strategies / plan. But right now, bull flag on the breakout looks nice, but all these gaps down here and the overextension in the indicators got me a little worried. Let's go take a look at the Nasdaq 100. Here is the Nasdaq 100. Just really want to show you once again, we had this big gap up over the 61.8% on the weekly time frame. We'll look at the candle that's forming, inverted hammer. We still have a few days. It's right by the overbought territory. This could very well turn into an evening star, which means that we have follow through the next following week if this holds like this, and we have a big red candle, which is very bearish type pattern. Now, this is also getting rejected, which we talked about in previous market briefs. This lower trend line, follow it all the way up. This is obviously getting rejected from that trend line. So we broke down, that's bearish. We broke out of this falling wedge, that's bullish. Now we're having kind of an inverted hammer, which could be bearish. So we're going to have to monitor this one closely. Let's look at the daily time frame for this. Here is the daily time frame. These charts are all very similar, so I wanted to spend a little bit more time on the S&P 500, and we'll just quickly go through these ones. But inverse head and shoulders broke out of the neckline. We have a lot of gaps. This gap has not been filled yet, and we have the gap above us as well. This right here is a very bearish type looking pattern. I forget what this is called, but just know that this type of pattern is pretty. Yeah, I would call this a reversal type pattern. Now the price bounced right from the 5 EMA, so that's good. But if we start closing below that and filling this gap, that could be pretty bearish for the Nasdaq 100. Now, if we close the gap, now keep in mind if you want to make bullish trades, if you want to buy dips, maybe for intraday, you can, in theory, buy right here where this gap gets filled. That should act as a level of support. Notice how the 5 EMA acted as support, and that's right above on the top of this window, and then we bounce. So if we start closing, it's very possible that you can just buy right here at, I don't have the exact price, but just above 11,700. Then you have a tight stop loss underneath it, and then you might be able to catch a little intraday bounce. So there's still a lot of opportunities in this market. I just want to point out the fact that all these indices look very similar, and they're looking, more bearish bias, but in somewhat of a bull context. So, that's why I've been so uncertain lately, because it just seems like the market's uncertain. It looks like we're just waiting for some good news, really, to be quite honest. Here is the Dow Jones. Once again, inverse head and shoulders, broke the neckline, looked pretty strong. This, I think that we closed below the 5 EMA, or it's pretty much sitting right on it and at the lower portion of this trend line. Let's actually see here. So it closed at 514 flat, and the EMA is at 527. So technically, yeah, the price did close below the 5 EMA, if I am reading that right. Wait, no. Yes, 527 and then 514. So yeah, so the price did close below it. That's bearish, but in reality, a few dollars is pretty much sitting on the price. But if you want to be very technically, it is closed below it, and it's still sitting right here on this trend line. So it's very possible that we keep on moving back and forth in here, or this is just signaling to us, hey, no, we're moving back down to that lower neckline right here, and that's right around 28,000. Now, I don't know if it's going to bounce from this, but if I were making an educated risk bet, so a high risk versus reward trade, this area, 28,000, would be my entry point for a long position. Why? Well, first off, the price would be having to come down to a major area that previously broke out of. Once resistance is broken, it then becomes support. This right here, 28,000, was resistance, and when we broke above it, we saw a lot of movement to the upside, so a retest could very well happen. A lot of the times, now, quite a few times, a lot of when we have breakouts take place, you typically get retests. Now, if that retest holds, that just acts more as a stronger level of support and farther into the future if it's ever tested again or if it keeps going higher. But so pull back down to here, 28,000, have a tight stop loss underneath it, or you wait. And honestly, too, this 20 period moving average right in the middle of the Bollinger Bands can very well be coming up into that level on as while the price pulls down. The price action is currently above it, so that means every day that passes, that 20 period moving average moves higher. So there's going to be some confluence in that area. It's going to be interesting to see how that one plays out. Here is the daily time frame for the Russell 2000. This was the only one that I was talking about that I would feel more comfortable shorting. And so far, so good. We broke out, and this was pretty bullish. We're still within this, little up channel right here, pretty steep. And we're coming to the lower portion of the trend line. This to me looks like it wants to come test this blue horizontal line, which is, previous resistance and support. So I wouldn't be shocked to see this as a buy range right here for a lot of traders at 157.50 and then having stops right below it. Even potentially down here by the 50 period. 50 period does act as support. You can see when we broke out, bounced, and then we finally broke down from it. So 50 period does have some history as support and resistance. So it's going to be interesting to see how that one plays out as well. Everything's so interesting. On the 2-hour time frame for the Russell 2000, remember we talked about this bearish crossover right here, still above zero, but it was worth noting. I say that a lot. And then we had the bearish divergence. Well, what do you know? Boom, boom, boom. Just, 6 hours of trading right here, just down to the downside. And we kind of broke this previous level of support. And now we're sitting right around 161.09. So if we start getting below 161, that could very well hit into this target, this kind of pink box that we have set up. Either, I don't know if it's going to be at the top range or to the bottom. I would say wherever the 50 period moving average is on here, we could probably see some sort of a bounce. So if you're an intraday trader, somewhat of a swing trader, I'd be looking at that as somewhat of an opportunity to go long. Keep in mind, always honor your stop losses, because if things go bad, things could go bad very, very quickly. So, elevator, typically the stairs up, which it feels like we've been taking the elevator up, but the elevator down is significantly faster than on the way up. So that was our section of all the indices that I want to talk about. We talked about the S&P 500, the Nasdaq 100, the Dow Jones, and the Russell 2000. A couple time frames. We discussed support and resistance. Now what I want to do is just kind of show some indicators. We talked about these yesterday, and I'm not going to try to keep in super detail today. If you want to go back to my previous video, you can go to the indicators section, which was, I think, the beginning, where I talked about, a little bit more about them. What do we got going on here on the Nasdaq 100 bullish percent index? Very quickly, very big overextended move right here. Just a very aggressive move up. We're now right at 85, and 85 means 85% of the stocks in the Nasdaq 100 are on buy signals. So a lot of people might say, no, that's actually bullish. And it very well could be bullish, but as thinking it from a more contrarian point of view, this big spike up could also be oversold territory or overbought territory. My apologies. And if you look at the RSI, we're overbought right here, getting frothier by the day, 71.85. It's likely to see some sort of a pullback when it gets up here. And we've been seeing these last couple of days a little bit of a pullback. So interesting to see how this one, might play out. Now, if we keep within this up way above 50 and we kind of just trend back and forth, then that's actually bullish. But if we start seeing a sharp decline, then that is pretty bearish. So just wanted to point out this indicator. Let's look at the NYMO. NYMO is the McClellan oscillator. Yesterday we were printing a number around 30. Today we're printing a number around 13. That's getting bearish. This is what I was talking about first off, if you're above zero, that means there's a positive breath in the market. It's good, but you got to look at the velocity of the move. And we were talking from way down here from minus 80, which is pretty aggressive. Okay, we're looking at a couple years back right here on this chart. Boom, we just shot up super quick to the upside. And that's, could be bullish if we hold with up there. But if we get a sharp decline, that's bearish. And we saw the same thing happen here in 2018. I've been talking about this for quite some time. Actually, a lot of traders have actually been talking about this for quite a long time. And the reason why is because it's actually important to take note of. If we start seeing a negative breadth start move really low really quick and start printing red numbers, that can very well be the indicator saying, okay, this market wants to head lower. Now, keep in mind with all the context going around us, okay, technicals matter, but really the market has been trading on stimulus hopes and vaccine hopes and the presidential election, who's going to win. And recently, this whole breakout of this inverse head and shoulders was around all that stimulus pump news that, hey, no, actually, we might be getting a deal. So let's run. And now, really, I heard Nancy Pelosi talk today, I think it was, and everything seemed extremely uncertain. So the likelihood of something passing now is, I mean, I've been so back and forth on this, but really it does, for now I'm standing on the sideline saying, okay, no way that this can happen before the election. But still, there's a part of me that says, who the heck knows what's going to actually happen? So I'm still up in the air. So I'm just coming from a perspective in the markets of uncertainty. And I think that's the safest bet for somebody like me. I don't know about your personal preferences, but for me, I'm risk off right now. And I'm going to show you an interesting thing that took place today in the bond market and the yields. But so this is the NIMO. I'm getting off track here. Another important one right here is the Nasdaq 100% of stocks above the 200 period moving average. We discussed that, hey, this is extremely overextended. This is, over 90% of the stocks, are above the 200 period moving average. Now we just saw this little bit of a downtick. Yeah, this big aggressive move, you might be like, well, that means all the stocks are very bullish. And yeah, that could be very the case, but also what it can mean is that they're very overextended and coming into a wall of resistance. And that's the way that I'm kind of looking at it. And if you look down here, right? Yeah, we're almost at the all-time market high. But this candle right here on the Nasdaq 100, as we already previously pointed out, doesn't look too good from a weekly perspective. So we're going to have to monitor this. But from my perspective, from my, view, what I'm seeing is this looks overextended. Not the time to go long right here. That's why I'm waiting for the pullbacks. Why not go short, Mike? Why wouldn't I go short? Well, that's a great question because I just don't have what it takes to stomach that overnight. Now that's my risk tolerance. I could look at more different strategies to kind of help ease me, but I don't want to wake up to news that a stimulus deal passed out of nowhere and then the market blow past me and just erupt a portfolio. So me personally, I'm just still that buy at major areas that have good risk versus reward setups. That doesn't mean that you can't short the market. Okay, I'm not against shorting the market. You can make a lot of money shorting certain markets and structuring a portfolio with advanced options. You can definitely do that. So do it if you can, and if you know how, I guess I should say. CPC indicator updated. Where we at? We are at 0.78. Holy moly. The stock market is very bully. That's the post that I posted the other day on Twitter. And why am I saying that? Well, first off, okay, this helps us determine warnings and sell signals. When it crosses below, that's the warning. The sell signal is when it crosses back above. Right now, this warning is kind of acting like a sell signal to me right now. But, you just keep... What I'm basically saying here with this signal is it doesn't mean that the market's going to crash. So let me reiterate that because people get confused. And it doesn't mean sell all your assets and go short. What it means is make sure you're taking some profits, okay? If you're way up in the green, pocket some of that in your pockets and maybe up your stop losses or consider hedging some of your long positions is what that means, okay? Doesn't mean the stock market's going to crash, but it does mean that if you listen to the warning right here, you could have potentially pocketed some money and then saved yourself from this pullback. Now what we're looking for is major areas of support that the price can pull back to and then potentially set up new trades. Okay, that's it. That's what I'm talking about. It's all about, protecting your money from the downside and, making your money work for you to the upside, or, vice versa if you short the markets, I guess. This is, I believe, the last indicator other than the VIX, which we'll get into right after this, but the NI high-low, which is the NYSE high-low index, just printing a very high number, okay, so overextended. And the market's kind of moving down. Typically, what you can do is look at this as a contrarian point of view as well. So we're saying 92 is the number that's printing. So a lot of the stocks in the NYSE, which is 2,000 plus stocks or 2,000 stocks, something like that. And it's a very important, economic indicator or index. And this means that, hey, no, everything is extremely bullish. And when everything's really, really bullish, that means that, hey, this could be the time to pump the brakes. So we're in that territory. We're overextended. That's what this is. That doesn't mean that we can't hold up there and track sideways, which is actually bullish. And this is a very laggy indicator. So, I'm just reading it for what it is at this particular point in time. Here is the VIX, the volatility index. Nothing really to report here. We're up a little bit, still within this inverse head and shoulders, still within this tight little channel. To me, it looks like it wants to head a little bit higher, which can put downward pressure onto the market. We're going to have to monitor this. If we start breaking this neckline, watch out. The markets are going to be moving lower if we start moving higher, obviously, in the VIX. So we still have this gap below us. And, there's still a couple of things that look a little bullish in the market. So, even what I didn't say was the S&P 500 and the other index could be forming just a big cup and handle and, move a lot higher. So that's all a possibility. But as of right now, I'm reading this as an inverse head and shoulders until further notice, until this pattern breaks. But it's still currently holding. So we will follow it day by day, week by week, month by month, however long it takes until it breaks. I love when I rhyme like that. Whatever it takes when it breaks. I forget what the other one was. There was a couple good ones. Pocket some profits. I don't know. Okay. Next chart. Here is the yields. So we got black, blue, red, and green. It goes 30, 10, 2, 3 are the yields, the bond yields. And you can see that right here on the top left, right, or top upper left. And you could also click the link in the description with this specific chart if you want to pull it up on your own computer or, on your phone, whatever. And what do we got going on? Well, the yields are heading lower. I wanted to talk about these spikes. So if you look at the blue line right here, this is, spike 1, spike 2, spike 3, all lower than the last spike on these specific breakouts. I'm bearish on yields, which means as yields go down, risk off takes place. Right? So bonds typically go up when the yields go down and vice versa. When we see these things spike, you typically see bond like the TLH go down. And down here are these are help me track inverse curves or yield curve inversion, I guess is the word. And when it falls below 0, that's what that shows. The higher that these spreads take place, this is the 10 minus the 2. That's a very important one. The higher these things go, it's better for banks, and the reason why it's better for banks is because they borrow short-term, like deposits coming in, and they lend long-term, so they make a lot of money with that. Now, rates are relatively low comparatively to throughout history, but something that we need to monitor and watch for is when they continue from a very big spike up to continue to draft down, and especially when they start crossing over like they did over here. That is yield curve inversion, and it's something that is a big warning sign, and the Federal Reserve looks at that indicator as the means for potential recession, and it's been very, very accurate. So always keep an eye on the yields and bonds, but I want to show you this chart of the TLH now. All right, so here's the TLH. This is the iShares 10 to 20 year Treasury bond ETF. And I just want to point out one thing. Look at the volume over here. Now, I know it's probably hard to see. I posted on Twitter. This spike right here is a record spike in bonds of daily trading volume. Now, I don't know exactly how to interpret this yet, but from my perspective, when volume is basically the amount of shares passed back and forth, right? So when trading increases, that means there's more focus, more intention. And when we look at this asset class, bonds, this is a risk-off asset, all right? Now we saw a pretty decent day. We're seeing yields spike lower, okay? First off, this is that the yield spike that we're talking about 3 spikes and they were each lower, and now we're seeing some of the biggest move in volume while the yields are going lower. And if you look at other big spikes that were above, 1.5 million, like boom, 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 and boom. Now the chart's hard to see, so you might need to zoom in, but they were typically followed by the movement up in treasury bonds. Not forever, but we typically saw follow through of a big spike to the upside. So that could very well potentially happen, and this could be signaling us, more money is moving into risk-off assets the bonds are going to be pushed up, yields are going to be going down sharply, and that could apply a lot of pressure on the economy. Now, when yields and rates go lower, that doesn't encourage savings. It encourages spending a lot of money at low prices. Now, whether the banks are going to be lending that money out, that's a whole nother story when you look at like the velocity of money and all these other charts. So I'm not going to get too much into detail with that. I really just wanted to point out, hey, no, there's a huge spike in volume trading activity right here. What's going on in the bond market? I don't know yet. So maybe you'll hear more people talk about this, or maybe you can even tell me somebody that's a bond expert that can kind of explain this a little bit better for us or for myself. So that'd be cool if you have any tidbits for me. Let's now go ahead and get into the commodities portion of this video and then finish off with the currency. Here is the chart of gold. Gold had a decent day today, up $12, but that was following yesterday's performance, which was not good. So yeah, it was an overextended move to the downside, and now we're seeing a little bit of an up day. But when you look at the trend line, gold didn't recapture that. It went above it and got rejected. So still, in my opinion, this doesn't look bullish to me, despite other people saying that the current trade looks bullish. I can be proven wrong. This could be somewhat of like an inverse head and shoulders. You got a left, a head, and then another shoulder, and then a curve, a neckline at the diagonal, and we might see a move higher. It's possible, but as I see it right now, I am not going to be convinced until, and I repeat this over and over, till we recapture the 50-period moving average, and it's not sloping down, so that's above 1950, and we hold that position. Until that happens, I am still short-term bearish. Overall macro view, very bullish. So gold might go down, offer a great opportunity to purchase more. I hope that gold just sinks to the floor, and then all of a sudden you'll probably just see the largest moves to the upside, extremely probably volatile moves to the upside. So like we did over here when we just went from 1800 to 2000 so quickly. So, we'll see. We'll watch this one day by day. Let's look at silver now. So here's silver. We were talking about this looked like more of a shorting opportunity than going long when it came to the upper portion of this channel. Right now, from this bear pull, and now we're tracking sideways to this kind of ascending triangle. If we start cracking below this lower trend line, goodbye silver. It's going lower without a doubt. Probably down to this $20 to 1963. With some up and down movements, probably, goes up, goes down. But it just looks, to me right now, it looks weak. So, I wouldn't be buying right here, personally. I would have to be convinced that we get above the 50 period and start cracking even higher and moving up and up. So to me, I'm looking for value, and the value is just not there at this particular point in time. Got to see how this what takes place in the very near future here. Here's crude oil. This gray box is like the trading range that I'm kind of watching. So I'm looking for a breakout of this, and then that would, make me very bullish. But right now, it's still within this channel. This was a bullish divergence on this double bottom right here, and we're seeing the price move higher, up 2% today. And we called this out the other day where we've been seeing a little bit of a move up. Now, if we get continuations and higher prices in oil, that's going to be good for individual stocks. I've been saying that the energy sector could really benefit from, well, let me think here. I think that certain individual stocks like oil companies can benefit obviously from higher priced oil. Transportation, such as airlines and just various other the Dow Jones transportation, they on higher oil prices will struggle. Now, currently, if you look at the transportation index, it's screaming at all-time highs, and there's a negative divergence taking place. So to me, it looks like a shift in momentum is going to take place. I think we're going to see that kind of pull back. And, obviously right here, we have a lot of other things going on that are underlying. First off, the COVID, the pandemic. So there's not a huge demand for oil. But as soon as that starts changing and there is a big demand for oil, we're going to see, one of the worst performing sectors, the energy sector, potentially start getting a lot better. So I'm still watching the energy sector, looking for signs of strength. It's still going down as of right now, so I'm just being patient. But when we start seeing strength, there's going to be some oil companies and other energy companies that are just going to benefit tremendously from being able to buy at these rock bottom prices. But you got to be patient for it, because these opportunities, they don't come around every single day. So when they're available, you got to be very methodical in your process in picking out individual stocks. And that's exactly what I plan on doing when I start seeing some opportunity. And I don't see it yet. I could be very wrong. It could spike up really quick, really fast, or potentially head lower. But I mean, from a technical perspective, I understand what's going on in the sectors. I understand, to an extent of what's going on in the economy. And now I have to focus on the patterns, the trends, and in the certain individual risk versus reward trades to really benefit from it. So that's all I got for here. Let's go now finish off this video with the US dollar. Not much to report on the US dollar, folks. This, to me, still looks like a cup and handle. It's in this down channel, so if we start breaking above, hello, we're going to move higher back up to double test this blue horizontal line. That was a fib level right there. If we start cracking above that, the dollar can move higher, and it can move higher quickly. So like I said, we had a down day today, but we recaptured the 50 period moving average. This kind of pattern right here, these red to this little doji to this green, that's kind of a in my personal opinion, that shows a lot of scare to the downside. Okay, so the shorters are feeling really good, but then all of a sudden the big bulls step up right here. And mind you, these moves actually mean quite a bit in the Forex market when you're considering all this leverage. So these moves are pretty aggressive. That big move right there probably scared all the happy shorts this previous day. So to me, they're biting their nails right now. Personally, if they're looking at this chart, they're like, oh gosh, this looks like a basing pattern. It looks like it gets strong. Maybe I should have my stop losses up here or maybe right here. But as soon as we get that sort of squeeze and the momentum moves up, it could go quick. So that's all I got here on this daily stock market brief. If you guys have any questions, leave them in the comment section below. I try to get to everybody. It's been getting increasingly more difficult these past month or so. So have a good rest of your day. Goodbye.